David R. Guttery is the president of Keystone Financial Group in Trussville, Alabama. David Guttery and Brandon Guttery are financial advisors and represent Emeritus Investment Company, LLC. Please stay tuned through the end of the video for additional important disclosure information.
Hello, everyone. Our 7th podcast of this continuing series will be narrowly focused today on 2 questions that I've received from many of you. First, David, will the economic impact of COVID-19 lead to another 2008-style financial crisis? And secondly, David, is it true that an investor must earn twice as much in a recovery as the amount lost during a period of decline? Also, just a brief programming note, we will be taking a break from the weekly podcasts next week, and we'll resume with our 8th podcast on the 11th of June. Please feel free to share the links to these podcasts with anyone that you feel may also benefit from having this information. Several of you have already done that, and it's led to the introduction to a few of your friends and family members, and that's awesome. I truly appreciate that. But if this is information that you think could be of benefit to others with whom you work, friends or family members, please feel free to share this with anyone. So as usual, let's begin with a current observation of market data. As we're recording this on the 28th of May, the Dow Jones Industrial Average closed up yesterday on Wednesday by 553 points and with a value of 25,548 points. Now, that's over 1,000 points higher than it was this time last week when we recorded our podcast. As we've discussed, the intraday low for the Dow Jones Industrial Average occurred on the 23rd of March at 18,213 points. Again, only time will tell if this proves to be the market low for the event. Conversely, the previous market high was established on the 10th of February with a value of 29,379. So just a point of reference, from the February high water mark to the 23rd of March, the Dow Jones Industrial Average lost 11,338 points, or a little more than 38%. So you're looking at a graphic now that we reviewed last week. Just to put things in visual context, since that low point, as of the time of this recording on the 28th of May, the market is higher by 7,335 points for a gain of 40.27% from the March intraday low. Again, I'm a visual person, and this graphic puts the last 9 months into context. While that might help to visualize the degree by which we've embarked on a potential recovery, it also affirms the angst that all of us as investors have. We all want this to be over. Just remember, patience remains the key. You can expect that any recovery will also include periods of second guessing and retracing, and this is a normal characteristic of any recovery from an acute shock. So I mentioned that our podcast today is going to focus on 2 questions, but I just briefly want to touch on the economic overview part of this. Within previous podcasts, we have evaluated input from the energy futures complex and the TED spread for clues about what those markets seem to be suggesting about the potential for a more robust economic environment ahead. These indicators continue to suggest that we have a much greater chance of experiencing a robust and expanding economy than otherwise. We will return to those observations, though, in our next podcast. So let's dive right into the first question. David, will this devolve into a 2008-style financial crisis? Gosh, I have fielded this question from many of you, and it's a great point, great question. My short answer is no. At this time, I see no indications of this devolving into a 2008-style financial crisis. Indeed, in my opinion, it would be the equivalent of experiencing snow in July in the state of Alabama. Look, the metrics just aren't there, and they are completely different today than what we experienced in 2008. So to illustrate this point, I'm going to draw reference to a few metrics and draw comparisons between the periods of time. So first, let's examine the business side of the ledger, business cash on hand. This is a graphic from a headline of an article that appeared in January of this year, 2020, from the Harvard Business Review. It asks the question, well, why are companies sitting on so much cash? Well, honestly, I didn't think too much about the article when I saw it 5 months ago, but I posted it to my social media anyway. The next graphic, though, gets into the article, and within it, it says that cash on balance sheets of U.S. non-financial corporations stood at $4 trillion as of the end of the year. Now, this was up from the $2.7 trillion figure of just 1 decade ago. Well, all right, clearly we were still dealing with the aftermath of the financial-induced Great Recession 1 decade ago. This article seems to indicate that corporations are much better capitalized than they were just 1 decade ago. But that's one data point, that's one source. So now what you're looking at is a graphic from the Federal Reserve Bank of St. Louis, and it depicts the total amount of U.S. corporation cash on hand and in U.S. banks. It seems to confirm what we just read in the Harvard Business Review. You can see on the right side of the graph the sharp upturn in cash over the previous 12 months. But you can also see to the left side of the graphic how much cash was on hand as we emerged from the Great Recession. Clearly, corporations are capitalized to a much greater and more sound degree than they were 10 years ago. All right, now this is another graphic from the Federal Reserve Bank of St. Louis, and this one depicts U.S. corporation cash and demand deposits. A little different. Clearly, this metric is at an all-time record high level. The shaded gray area in the middle of the chart covers the Great Recession period of time between 2008 and 2010, and clearly the amount of cash on hand in demand deposit accounts is twice as high today as it was then. So what about access to cash? All right, well, here's another graphic, again citing the St. Louis Federal Reserve Bank. The M2 money supply has increased by 37% over the previous 4 weeks. Now, it's kind of hard to tell if you look at the right side of the graph because this covers about a 10-year period of time, but that's a sharp jump in just the last few months. But this doesn't seem to be an action taken in desperate response to an overly leveraged situation like we had in 2008. But rather an effort to capitalize banks and lending institutions to an even greater degree to ensure that no disruption in capital markets occurs resulting from efforts to temporarily close the economy, flatten the COVID-19 curve, and fund spending facilities that were promulgated in an effort to support the income of furloughed and employees that were laid off. So on the corporate side of the balance sheet, things look about as sound as we've seen them in terms of just cash on hand and liquidity. And it's a stark contrast to what we had in 2008 when corporations were highly levered and had very little cash on hand. Well, what about the household, the personal side of the equation? What about all of the debt of the households where people have lost their jobs or income was disrupted? Again, great question. So as far as employment is concerned, we can't just add the headline numbers together and arrive at any conclusions. Remember, the 4-week moving average gives you a much better indicator of how many previously laid off workers have either returned to work or have been reclassified as being furloughed with or without pay. Today, we learned that while adding all of the claims for first-time benefits breached 40 million, the continuing claims number dropped to 21.05. So please don't let the sensationalized media leave you with the impression that there are 40 million people out of a job. There aren't. It's half that, as of today anyway, and that number has dropped significantly now in 5 straight reporting periods. So now we're looking at a graphic that depicts the 4-week moving average, and this is the most current graphic from the St. Louis Fed. The 4-week moving average is down to 2.608 million from 3.543 million just last week. It's down 55% from the April 18th high water mark. So no, the household income situation as a function of jobless claims has actually improved dramatically over the last 6 weeks. So let's stay with the Federal Reserve Bank of St. Louis for a meaningful insight into the most current debt stress levels of the average household. So we're again looking at this graphic from the St. Louis Fed. It depicts debt service payments as a percentage of personal disposable income. Clearly, the percentage of household debt as a function of disposable income hasn't been this low since at least 1978, which is at the left side of the graphic, and frankly, it may be lower. It may go back even further than that, just where this graphic cuts off. But you can see that this percentage spiked right as the Great Recession began to unfold. Again, the point is to illustrate why this period of time isn't likely to devolve into another financial crisis, and I think this graphic clearly shows that the foreclosure threat as a function of household debt is significantly lower than it was as the Great Recession began to unfold. Finally, on this topic, we're looking at a graphic that we reviewed last week. It's the TED spread, but it goes back to 2007. If the bond market sensed that another financial-induced crisis was on the horizon, then it is very likely that we would see a spike in the TED spread like what we observed in 2008 on the left side of this graphic. Now you can see the spike on the right side of the graphic that occurred on the 23rd of March and the tightening that has occurred since that point. This is yet a fifth piece of anecdotal evidence that suggests that indeed we are not seeing the same elements that combined in 2008 as the financial-induced Great Recession began to unfold. So question 2, David, to what degree must I recover to break even for a loss? Well, look, there's a perception out there that you must earn 100% just in order to break even from a 50% loss. In that scenario, you do. If you started with $100 and watched it decline to $50, then you're down 50%. From the $50 level, you would indeed have to earn 100% or $50 in order to break even and see the value of that investment return to $100. However, some are taking this example and applying it to any loss, and that's where things start to break down. If you're down 20%, you don't need to recover 40% from that point just to break even. You need to earn 25%. So here we see the graphic of a bell curve, a normal curve. And I'll explain why I'm using this in just a moment. Let's assume a beginning investment value of $10,000 on the right tail at the positive 3 standard deviation and a $1 value on the left tail at the negative 3 standard deviation. If you lost 50% of the value of your investment, then you would be at the 0 standard deviation, or right there in the middle. It is at that point where you'd have to earn 100% to recover from a 50% loss. And the point of using the normal curve is to illustrate the geometric impact of losses on efforts to recover. So now you're looking at the spreadsheet that goes behind that bell curve. And I put this together to illustrate this point with some of my clients. If you lose $1 on the right tail of the curve, and you can see that down there toward the bottom highlighted in green, no, you don't have to earn $2 to break even. You have to earn $1, and that is 0.01% in order to break even. Go up one line. If you've lost $1,000 or 10%, then you have to earn $1,000 or 11.11% on the 9,000 remaining to break even. Go up one line. If you lose $2,000 or 20%, then you have to earn $2,000 or 25% on the 8,000 remaining in order to break even. Now, we've already talked about having to earn 100% in order to recover from a 50% loss, and that's at the 0 standard deviation highlighted in yellow. Clearly, it's harder to recover from more significant losses. If you're down 70%, for example, then you need to earn $7,000 to break even, but that is a 233.33% on the $3,000 remaining in order to break even. So I just wanted to offer this as clarity, given the number of you that have asked about the degree by which you must recover from the March 23rd levels in order to break even. Indeed, many of my clients have discovered within our individual conference calls and Zoom meetings that we only have a few percentage points left to go, or frankly, they're already in positive territory for the year, while the market itself remains negative, because they have followed my advice of investing through the crisis and they made it work for them. So in conclusion, no, period. I do not see the economic impact of COVID-19 developing into another long and protracted 2008-style financial crisis. I've referenced the St. Louis Federal Reserve Bank and empirical data as the basis for this belief. Please use these inarguable facts as ballast against the sensationalized waves that are coming at you from the mainstream media. Their primary job is to scare the daylights out of you long enough to make you watch the next commercial. I also hope that reviewing the bell curve and the spreadsheet helped put the degree by which an investor must recover to break even into greater context. No, I mean, if your losses were less than 50%, and for all of my clients, they were nowhere near that mark, then no, you don't have to earn 100% just to break even. That is a myth. So hopefully that spreadsheet put that in greater context. Now you're seeing the graphic of the bridge again, and look, again, I'm a visual person, and I really just want to use this to reinforce my belief that the provisions in the CARES Act are enough to span this economic closure event and maintain the purchasing momentum of individuals from the record strength that we observed in February to now on the other side of this chasm. At this point, on the 28th of May, I see absolutely no reason to doubt that being the most likely outcome. Still, over the coming days and weeks, you are going to continue to hear conjecture about a double-dip recession or a W-shaped recovery and a longer than projected economic contraction and a less than robust economic recovery. And yeah, the market will ebb and flow on this. Right now, from what we can quantify, that does not appear to be the most likely potential outcome. So stay focused on where we're going. As we've discussed before, you can't react to a shocked market. If you try to do so, it historically creates a much larger problem of having to battle the emotional aspects of when to return to the market. If your objectives remain in the intermediate to distant future, make this crisis work for you. This shocked market, at least so far, is following the same pattern as 15 of the last 16 recoveries from acute shocks. So again, patience is the key. Let's stay focused on where we're going and not so much about where we are. Thank you for your attention. Again, we're going to skip next week, but we will have our next podcast for you on the 11th of June. In the meantime, stay safe, and we'll talk to you again soon.
David Guttery and Brandon Guttery offer products and services using the following business names: Ameritas Investment Company, LLC, AIC, member FINRA, SIPC for securities and investments. Ameritas Advisory Services, AAS, for investment advisory services. AIC and AAS are not affiliated with Keystone Financial Group. Products and services are limited to residents of states where the representatives are registered. This is not an offer of securities in any jurisdiction, nor is it specifically directed to a resident of any jurisdiction. As with any security, request a prospectus from your representative. Read it carefully before you invest or send money. A representative will contact you to provide requested information. Representatives of AIC and AAS do not provide tax or legal advice. Please consult your tax advisor or attorney regarding your specific situation.